Hello investors, my name is Stuart Kruse and welcome to Kruse Asset Management's video chart of the day. And today we're going to be talking about small cap stocks. Small cap stocks are generally stocks with a market capitalization or a valuation of less than $3 billion. To put that in perspective, a large cap stock will probably be 25, 50 billion and up. And these mega cap stocks like Amazon and Apple and Microsoft are in the 1.7 to 1.5 trillion dollars. So a small cap stock is considerably smaller. Now, generally, small cap stocks are thought to be more volatile and traditionally can potentially give you more upside than a large cap stock. Because when you think about it, if you're looking at a large cap stock, let's say like Amazon, that's at $1.7 trillion, in order for Amazon to grow at 10%, they need to add $170 billion of market cap onto their company in 12 months. So what that would mean is they have to add a company that's larger than, let's say, McDonald's or Starbucks every 12 months onto their company. And it tends to be a tall order. But if a small cap is worth under $3 billion, then their potential to grow into new market areas and new segments is generally much greater. Unfortunately, we're going to look at, here we have the Schwab's US small cap ETF up here, and year to date it's down 6%. And just to put that in perspective, if we add the S&P total returns, and I'm going to put this on the same panel here. If we add the year to date total returns, the S&P is up 4% while the small cap is down 6%. So there's a 10% gap between those two. And what we've seen over time is small caps have been underperforming because in this current environment, the rich have been getting richer, the bigger have been getting bigger, and the small cap in this environment have been struggling because it's harder to really get scale and to really rebound because oftentimes they don't have as much cash and they can't handle some of these crises that come along periodically. So if we look out even 3 years, the S&P is up 42%, where small cap is only up 10. 5 years, that gap is still pretty wide, 75 to 24%, and over 10 years, 264 to 146. So it's more than doubled. So why invest in small cap? Well, if you look through here, small cap actually outperformed in the beginning part of this 10-year period. And it was more recently, since 2016, that the gap opened between large cap. And generally, we see a reversion to the mean. So it's very possible that small cap will outperform large cap in the immediate future. So let's go back to our year-to-date numbers. And I'm going to take the S&P 500 off of this chart. And I'm going to add some other names. So Kruse Asset Management runs a quantitative small cap portfolio called our QSP, Quantitative Small-Cap Portfolio. And these are the top 6 names out of 35 names that we evaluate that are in our small-cap portfolio. So Natural Grocers, Bright Sphere, Sportsman's Warehouse, Marine Max, Escalade, and Echo Global Logistics. Now, none of these are tech stocks. Some of these are consumer stocks, financial stocks, retail and boating, sports stocks. But as you can see here, on all these stocks, the S&P itself was down 6%, but every single one of these stocks has had a positive return, with the Sportsman Warehouse, and that kind of makes sense in this coronavirus age, is up over 100% year to date. So these are the kind of returns that you can get with small cap stocks, maybe names that you haven't heard of. So how does Kruse Asset Management select these small cap stocks? Well, we use a variety of characteristics based off of a fundamental question: what characteristics tend to lead towards outperformance? And let's buy those stocks with those same characteristics today. So some of them, we'll probably use a dozen or so of these characteristics, but some of them are value related, like PE ratios. And if I look at the PE ratio of some of these stocks, and I'm going to go to a single panel, and I tell you what, you already saw the pricing. So here's the pricing of these stocks, and I'm going to take the S&P 500 off of this chart, and maybe we just go to the PE ratio chart. So we're going to let this compute a little bit. there we have it, the PE ratio of these small cap stocks that were up on the board. And these are, let's look at the actual original numbers. So here we have some pretty astronomical PE ratio from Echo Global Logistics. And some of these others are in the 20s, 28s, 11, and 6 is a much more modest PE ratio. Now, keeping in mind, let's say a PE ratio of Apple is around 32 right now. So it's a little bit higher than everything we have on the board. If I just if I put up Apple on the board, you're going to see Apple's PE ratio is 33 right now. So it's higher than 5 out of 6 of these names. All right, but PE is not the only thing that we look at when we look at valuation and trying to buy a dollar of earnings of these companies at a good value. So we use a multitude of quantitative metrics. Some of them are momentum, some of them are asset efficiency, but these are all valuation metrics. So price to book, if we look at a PE ratio here of Echo Global Logistics is the highest PE ratio. It also has one of the lowest price to book metrics. And what does that mean? Is how much is a price to its book value or its breakup value. So that in theory, if you broke up this Echo Global Logistics and sold off all its parts, then it's only priced at a little bit under 2 times that number. And so in theory, it should be able to use its assets to make more money and become and utilize the assets better than just breaking them up. So that's one valuation metric, PE ratios and price to book. And here's another one, price to sales. How many dollars are we pricing per unit of sales? And again, when we look at this top line of Global or Echo Global is at a high PE, but a very modest price to book and also a very modest price to sales. It's priced at 0.3 to sales. So for every dollar of sales, the price per share is 0.3. So when you kind of measure all these in and build them into a model, some of these offset. So you have an expensive PE, but very inexpensive price to book and price to sales, and vice versa. Here we have a very expensive price to book value for BrightSphere, but a pretty modest PE ratio for BrightSphere. So when you build these models and weight them over time, they tend to outperform, as we saw with the actual price level of these particular characteristics, significantly outperforming the Schwab S&P, the Schwab US Small Cap Global. So if you're interested in Kruse Asset Management's quantitative portfolios, we have a small cap, we have an international, and we have a large cap. Please go ahead and schedule some time with us. I'll put a link to a calendar on this post if you want to understand a little bit more about our quantitative approach to investing. Thanks, and this is Stuart Kruse with Kruse Asset Management's video chart of the day.